Hey, Joe Gardner from Covers & Co. So today I wanted to touch on livestock price insurance, something that we use as a risk mitigating tool on our farm. And there's lots of different perceptions about livestock price insurance out there. And I just wanted to talk about our experience on our farm and why we see value in the program itself. So the first thing I wanted to touch on is just how it works. So essentially, livestock price insurance is just a hedge. So you're just setting a floor on what you're going to sell a calf for come fall. This year, our floor was $2,870 on our 500-pound calf. So all we're doing, we can still capture the upside. All we're doing is on that date at the end of our contract, if calves are less than $2,870, the government or the livestock price insurance will pay us up to that amount. So what it gives us is an ability to be able to cash flow into the future, knowing, okay, no matter what chaos happens in the world or in the cattle industry, that we're not going to sell a calf for less than $2,870. Now, later in this video, I'm going to talk a little bit more about how to use livestock price insurance as security on interest-free cash advances. But right now, I want to get into exactly how you book it and how to read the graphs that are available to us. So this is the livestock price insurance premiums from April 1st. This is the Sask Man price insurance if you're in Alberta. They're very similar to this, but this is the one that I'm familiar with, so we're just going to go with Mansask. So down the left-hand side here, the insured index. So that is the price per hundredweight that you are insuring. Inside the chart is your premiums. So if you want to insure your calves till September 21st, it's the first column. Till October 19th, it's the second. 16th of November, 14th of December, you get to choose when your contract expires. When your contract expires, it doesn't mean you have to sell your calves. It's just what the price is in the marketplace on that day. So if it's you're on your 5-weight steers, if it's less than $5.70 a pound or $5.70 per hundredweight, the program will pay you up to that amount. So there's two different strategies you can do when taking out livestock price insurance. My strategy is utilizing it as disaster insurance. So the market, something happens unforeseen, the market crashes. I just want to know that I've got a portion of what I'm expecting from my calf safe, essentially. So what I recommend producers to do is just pick the lowest premium. There's not a huge difference between the insured index on the left-hand side. You know, the highest one you can get is $6 a pound, and the lowest is $5.70. So there's not a huge spread there, but there is a big difference in the premium. So if we take the very lowest premium, $570 per hundredweight, and that's going to cost us $9.44 per hundredweight. So if our calves come September are going to be in the 500-pound range is usually what I do. You take that 570 times 500-weight contracts, which gives you a floor on your calves of $2,850 and gives you a premium of $47.20 per calf. Now, on the other end of the spectrum, if you say, hey, these calf prices are good and I want to insure the absolute max that I can, you go up to the left-hand side, and I use the 598 line on the chart here, and we're going to go right over, insure them out to December 14th. That's a premium of $20.87. So on $598 on 500 weight contracts, that gets me a insured price, the lowest price we can get of $2,990 with a premium of $104 per animal. So you see why I kind of shy away from going the absolute maximum amount premium versus the lowest, which is the dollars in my pocket aren't a whole lot different, but the dollars leaving my pocket in the premium that we're paying is significant more. So what I like to do is just take the lowest premium that I can get. I know I'm covered and at a reasonable rate. Now, I should say I am not a lover of insurance. I don't use any insurance basically in my life. We are out of crop insurance. You can ask my wife. There's not a whole lot of insurance on on our house. I just don't see it as something that's going to benefit us in the long run as long as we make the right practices. Where I do see value with the livestock price insurances is these macroeconomic factors where things affect the cattle industry pricing that is so out of my control that if we can put a floor on it, it just gives us a good plan going forward. All of our cash flow numbers are based on our livestock price insurance because I know that is the worst that we are going to do from a cash flow standpoint. If the market holds or if the market goes up, we get to capture all that upside. We pay the premium and we're happy doing it. It means that the cattle market has stayed strong for another year. The other thing that is a huge advantage if you are a farm like us that has been taking operating lines out from the bank is you can use your livestock price insurance as security to access interest-free cash advances from the government. So I looked up some of these numbers this morning. On one calf cash advance, I think they pay you about 60%, but that works out to $1,895. You can get cash advance interest-free, and they will give you up to $250,000 in interest-free money. So that works out to $1,895 times 131 calves that we're insuring. So the premium is going to cost us $500. Now, the $250,000, if we're not already using interest-free cash advances, if we go to the bank and access $250,000 from the bank at an 8% interest, and if we assume we're only getting the cash advance for 8 months, we got to account for that. So for 8 months on a $250,000 loan is $13,333. So if you use the livestock price insurance to access interest-free capital from the government, your interest savings from that is $6,833. So you can pay your premium on those 133 calves or 131 calves and have a savings on top of that of $6,800 in interest. So I know livestock price insurance isn't for everyone. Like I say, we not a big insurance believer, and we went years and never used it. But with the cattle market where it's at today and so much value out there, I think it is a good idea for farms to take a look at as just setting a floor on your market. So in Manitoba, we just contact Manitoba Crop Insurance. I have a relationship with the person over there. It takes about 5 minutes to get your calves insured. You do have to pay your premium up front, or you're going to be paying interest on that. I think they give you 30 days. But if you take that livestock price insurance and then use it as security to take a interest-free cash advance rather than taking an operating line, you can actually increase the amount of cash flow in your operation. So that's something that we've done the last few years. Honestly, grateful that we haven't had a livestock price insurance claim because it's meant the market has kept going up. But we're going to keep paying the premium until we do see whether it's a correction or a downturn. Hopefully this helped and you got something out of this recording. I do not work for the government. I just think it is one of the rare events where they've got a helpful program for producers. So that's all for today. Thanks for listening. Have a great day.